All right, welcome. In just the next few minutes, we're going to break down the core ideas behind smart investing. We'll cut through the noise and focus on some powerful, time-tested principles that can help you build long-term wealth starting right now.
Okay, let's kick things off with the big one, the question that really gets to the heart of it all. Can you actually outsmart the market? Is it really possible to consistently pick the winning stocks, or is it just a fool's errand? Let's dig in.
So to get why beating the market is so ridiculously hard, you have to appreciate what it really is. It's not just a collection of stocks. It's a relentless, hyper-efficient information machine. Think about it. Millions of people, from regular folks to supercomputers, all analyzing every scrap of public information all at the same time. And that creates a force that we really need to understand.
And this idea is actually wrapped up in a pretty famous theory, the efficient market hypothesis, or EMH. So what does that really mean in plain English? Well, it basically says that by the time you hear some big news, like a company had a killer quarter, the stock price has already moved to reflect that. The information is already priced.
Right, so here's the key takeaway. Stock prices don't really move because of what we already know. They move because of surprises, new information that nobody was expecting. And you can't predict a surprise, right? That's what makes it a surprise.
And get this isn't some new idea cooked up last week. A French mathematician named Louis Bachelier wrote this way back in 1900. It's an idea that's been around for a very long time. So if we accept that trying to outsmart everyone is, well, probably not going to work, what do we do instead?
Okay, so if we're not trying to beat the market, the whole game changes. The goal is no longer finding that one magic stock, that needle in the haystack. The goal is to smartly manage the risk of owning the entire haystack. And that leads us to something that people in finance famously call the only free lunch out there.
We've all heard the saying, right? Don't put all your eggs in one basket. Well, it turns out in the world of finance, that's not just folksy wisdom. It's a scientifically proven strategy for managing risk.
And the fancy name for this is modern portfolio theory, or MPT. Now, the genius behind this Nobel Prize-winning idea isn't about finding the next hot stock. No, it's about combining different assets that don't always move in the same direction. Think of it like this. Sometimes when stocks go down, bonds might go up. By owning some of both, you can actually smooth out the ride and lower the overall choppiness of your portfolio.
And this chart, it just shows you how powerful that is. Look, if you put all your money in one stock, you're riding a roller coaster tied to that one company's fate. But with a diversified portfolio, you spread that risk out. And that is the free lunch. You can literally lower your risk without having to give up your expected return. It's an incredible trade-off.
All right, so let's recap. We've got two huge ideas on the table. The market's super efficient, and diversification is your best friend. So how do we actually do something with that? How do we put it into practice?
Well, this brings us to a really elegant, simple solution, championed by Vanguard founder Jack Bogle and his followers. The idea is, if you can't find the needle in the haystack, why not just buy the whole haystack?
And this philosophy is just beautiful in its simplicity. It really boils down to 4 key steps. First, use low-cost index funds so you can own a piece of everything easily and cheaply. Second, make sure you diversify globally. Invest in companies all over the world. Third, and this one is non-negotiable, keep your costs as low as humanly possible. Fees will eat away at your returns over time. And finally, maybe the toughest one of all, don't try to be a hero and time the market. Time in the market is what matters.
And that last point is so important, it's worth hearing this great line from Charlie Munger. See, the real power, the real wealth-building magic comes from compounding over decades. And the worst thing you can possibly do is interrupt that process by panicking and selling at the wrong time.
Okay, so all this talk about buying the whole haystack can feel a little abstract, right? So let's zoom in for a second and remember what's actually in that haystack. What do you really own when you buy a stock?
Really think about it. When you click buy on a stock, what are you actually buying? Is it just a ticker symbol on a screen or something more? You're not just getting a ticker symbol and some flashing numbers. Nope. You are buying a tiny fractional piece of a real business. And that business has stuff it owns, we call those assets, and stuff it owes, we call those liabilities. And the way all this fits together is shown on what's called a balance sheet. It's based on a really simple equation. Everything a company owns has to equal what it owes to others plus what's left over for the owners. And that part left over for the owners, that's the shareholders' equity. You can think of it as the company's net worth.
Let's put some real numbers to this with a company everyone knows, Walmart.
As of early 2025, Walmart had about $261 billion in assets. You subtract its $163 billion in liabilities, and what's left is about $97 billion in shareholders' equity. So when you buy a share of Walmart, you're literally buying a tiny sliver of that $97 billion pie. All right, we've talked about the theory, the strategy, even what a stock really is. But honestly, none of that is the most important part. We've saved the most critical piece for last.
Because here's the hard truth. The biggest risk to your money isn't a market crash. It's you. It's the person looking back in the mirror. Think about it. The news, the headlines, they're all designed to make you feel fear and greed, pushing you to buy high and sell low, which is the exact opposite of what you should be doing.
Which brings us full circle to the most important piece of wisdom from Jack Bogle himself. You have a plan, and then you have the discipline to stick with that plan, no matter what. Through all the crazy ups and downs, the investors who really win are the ones who just tune out all the noise and stay the course.
So let's end with this one thought. The market is going to crash again. That's not a prediction, it's a guarantee. It's a normal part of how this works. The question isn't if it will happen, but when. And when it does, will you be ready?